Hey guys, welcome to the Top Percentile. My name is Anay Dave, and I'm an alumni of Jamnalal Bajaj Institute of Management Studies. As someone who's working as a credit front office analyst in one of the biggest investment banks in the world, one of the questions I'm most frequently asked is how do you get into such a bank, and what are the skills or topics that you need to actually break through this role? In this video, I'm going to break it down for you. It doesn't matter if you're someone who's currently studying for the summers, currently studying for the finals, or is preparing for their MBA entrance exams, or any exam or any interview for finance. This is a video for you. I'll be covering everything from start to finish, including sources. Everything will be in the description. And I'll be linking to the resource that I'm using so that it's easy for you to click through and refer to what I'm saying throughout the video. But it's going to be a very well-documented thing from start to finish, explaining what you need to do and why it is important from an interviewer's perspective. For some context, I interviewed at one of the leading investment banks when I was in my MBA. So I was a summer intern over there. I converted that into a full-time offer and was sent to New York for 5 weeks for further training in that role. So what I'm teaching today is a culmination of what it took to get into the role, plus a lot of knowledge or sources that I've gained over time. So without any further ado, let's just jump straight into it. The first thing that you need to know, the most important, it's the language of finance. It's how to read financial statements. This, although considered easier compared to the others, is absolutely essential. You need to understand how to read and interpret financial statements, the financial statements being the balance sheet, cash flow statement, income statement. You need to understand each and every line here. You need to understand what goodwill is, what is intangible asset, for example, why that ties into a company's revenue or losses, or how impairment works. You need to understand the linking of each and every financial statement and then trying to figure out what that means for a company. The best source over here is Investopedia's Guide to Reading Financial Statements. You'll find that linked in the description. It should be on your screen right now. Another source for this would also be Zerodha's Varsity. It covers it more from a basic perspective. It kind of introduces you as if you've never done finance. So based on where you are right now, I would say you need to select one of these two. If you're someone who's already understood what the basics are, the third level that you need to look at is the CFA course. You find a couple of books behind me. I've completed my CFA L1, and I strongly suggest you to read Level 1 FSA, Financial Statement Analysis, if you haven't so far. It probably is called FRA now, Financial Reporting and Analysis. Whatever it's called, financial statements is what you need to know. It's very important. You need to understand what the line items are and how they tie into the company's financial performance, health, and how to actually analyze statements using them, right? That's the first part. The second thing that you need to look at is financial ratios. This is kind of an offshoot of the financial statements that we've already spoken about, but this is required because a financial statement or a line item might not give you enough information as to what a company has been doing over time or how it compares to its sector. So industry analysis and company analysis is something that you do through financial ratios. These can include liquidity ratios, profitability, solvency ratios, etc. Two key questions that you need to ask yourself here are: what makes a company stand out in the industry, and what makes a company a part of its industry? Standing out would be something like if a company is very asset light in an asset heavy industry, and standing in or something that is common across it would be probably something like a low profit margin, or being asset heavy for that matter, or something like that, right? What makes it belong to its category and what makes it stand out. If you can do this using ratios, you're already using your financial statement knowledge to a good use, and you can move on to the third part. Sources for this would be Investopedia's Guide to Financial Ratios. You'll find the link in the description and on the screen in front of you. So please refer to these whenever you want. It is a very thorough guide. Again, as I mentioned, if you are someone who's already done this, the CFA book, the CFA curriculum is going to be great. Shweza books are something I keep recommending everyone. They make it very easy for you. It's very easy to read, but please look into that. If you want more tips on CFA, please let me know in the comments. I'll be more than happy to make a guide on that as well. The third topic that I want you to look at is corporate finance. This is important because there are many companies that come to your campuses. They might ask you for a lot of information on project finance and how you should manage working capital, dividend policy, etc. Management of money from a corporate perspective is very different from management of money from a personal perspective. When we invest into companies, it's a very different thing. So you need to figure out what are the core technical subjects that you need to know over there. A lot of these would be NPVs, IRRs, how that entire thing works out. So an NPV is the net present value of your future projects. An IRR would be an internal rate of return. A lot of this will be covered in the link that I'm going to share. And again, Investopedia is a great resource for this. So Investopedia's corporate finance is the best source for this. When you look at how you compare this, I also want you to think about how these investment decisions change over time. You need to think about if you as a company or someone working in the corporate finance team decides to go for a project A versus project B, What are the main parameters that you look at? What would affect that decision? Would it be starting off fresh? Would it be a greenfield? That's a greenfield investment. Would it be a brownfield investment? Would you want to start in a new country, in the same country, make new products, make the same products, use existing factories, etc.? A lot of these things matter, right? At what cost of capital would you be working? All of these things matter a lot. So learn the basics of corporate finance, how the entire thing works. There's a separate pointer I have on capital budgeting and NPV, so I'll come to that later. But the fourth valuable thing that I want you to learn is time value of money. I think this is something that encapsulates a lot of personal investing and money management for corporates. It's very important to start understanding how time affects the value of money, how today's interest rates, how today's discount rates affect future values, present values, how we look at two different investment decisions from the perspective of either investing today versus investing tomorrow, and how that affects us, right? Because this is something that's used in, as I mentioned, in your corporate finance. It'll be used in equity models when you're valuing a company. Same way, when you're valuing companies, you'll value bonds, which is used in the capital and credit markets. You'll use a lot of these things each and everywhere, right? So you want to kind of understand how the time value of money affects your investment decisions. Your best source for this would be Khan Academy's Time Value of Money. They have very detailed step-by-step videos. If not this, Ashwa Damodaran has a course on his YouTube channel. You'll understand time value of money very well there. But as I mentioned, Corporate Finance Institute and Investopedia are two great sites for anything that you want. Googling is your best friend. So just Google it, find the source. But this is the one that I've selected for this video. The fifth thing that I want you to focus on is capital budgeting. This gets a bit more complicated than just corporate finance, but you kind of need to go into the depths of NPV, IRRs to understand how to evaluate projects. You need to look at more things, right? You need to understand what WACC is, what is the weighted average cost of capital. That's in fact my sixth point as well, how we kind of going into how you decide whether a company wants to raise debt or equity, what that would affect, how that would affect their cost of capital, how that would affect their future projects, their NPVs, IRRs. You need to think of these concepts, understand how this links into a company's, again, the financial statements, how their future looks, how their cash flows look as a result of that. You kind of need to start making notes of this. The best source for this is CFI's cost of capital codes. Whatever I'm mentioning right now, these are the important things that you need to know. These are what you kind of need to focus on more and more as you go ahead. This really matters a lot. The sixth thing that I want you to focus, because I've kind of combined 5 and 6 together. So let's just focus on this. Technically it was the seventh, but let's look at this as the sixth. The sixth thing that I want you to focus on is what are the different instruments of investments and what are the financial markets like. You kind of need to know what the basics of financial markets are, including the stock market, bond market, derivatives. What instruments are available? What other things are there? What are the futures and options? How do people invest in bonds? How is debt rated? How is a stock rated? How do you evaluate it? What are the main measures to do this? A lot of these things matter a lot. So for this, if you're using the CFA books, there's an entire chapter on alternative investments. You'll find a lot of data on that. There's a chapter on derivatives. There's a chapter on equity portfolio management. You'll find everything in CFA books. All of this, again, will be combined into shorter notes by Corporate Finance Institute, Investopedia, and Khan Academy. All three links in the description. So just click on it, read as much as you can, understand why each one is different. This kind of links to the earlier point on cost of capital, because you need to know the difference between why a company raises debt or why they choose to raise equity, and how that kind of ties into the future of the company, right? And when you think of financial markets and instruments, you are thinking from both perspectives. You're thinking from the perspective of you as an individual. If you had to run your own startup, would you rather choose equity or would you choose debt? And you need to think of this from a late stage corporate. What would they choose? What would they prefer? What would be cheaper for them, and how would it affect their financial decision, right? So think about financial markets, think about where you want to invest your money as well. And I guarantee you, if you do this right now, then in a couple of months, you'll have a very good grasp of what you want to invest in, what you want to work in the future as well. Because 10 years from now, when you made a lot of money, you will want to know where to invest in. If you start getting knowledge from now, you'll kind of understand where to invest. Leading on to that part, the seventh topic, risk and return. This is absolutely essential, and I'm adding this as a separate bullet point because I want you to focus on this as a separate guide. People don't think about risk enough. People don't think about risk. They just talk about how much return people are getting. People invest in crypto, people invest in startups without thinking of what the risk is like. But it's very important for you to think about that side of things. What can happen in the world, or what is not factored into the price at a certain price point? What else could happen, right? So you kind of need to figure out what the risk looks like and how the risk affects the return. As you'd be knowing, usually return is always adjusted for risk. So if something is giving you a higher fixed return, it's usually because it's a lot more risky. That's why equity tends to be more attractive than debt. But in times like this, where equity is up and down and you don't know what's happening, that's where people move to debt. That's what you need to know. You need to figure out where you stand as well and how to measure this. A good way of measuring this would be the CAPM model, the beta model. A CAPM is the capital asset pricing model. Again, link of everything in the description. The best guide here, Investorpedia's risk and return guide, right? The eighth point that I want you to focus on, this is kind of coming to the end of everything and the culmination of everything that you've learned so far, is valuation methodology. When it comes to valuation methodology, this is probably one of the most challenging fields. But if you can crack it, if you can understand how these things work, you can bring everything that I've said so far into logic, into numbers very well, right? When you talk about valuation methodology, you are focusing on things like DCF, which is the discounted cash flows, which takes cash flows from today to the next 10 days, discounts that to today. So let me break that down. I take cash flows from today to the next 10 days. That is my analysis of financial statements, analysis of financial modeling, how I think the company is going to grow further, what is happening in it, how it moves over time. I'm trying to put my own view on it. So I'm using my financial statements, financial ratios, thinking of what new projects they're working on, whether they're funded by debt, by equity. So I'm thinking of capital budgeting, I'm thinking of corporate finance. As I mentioned, if you're hearing all these terms again and again, it's on purpose. So go back to the video, go back to where I spoke about it, think about what was said at that time, get it back to this part of the video, and try to link what I'm saying together, right? So when I think about valuation, when I think of DCF rather, I'm thinking of cash flows the next 10 years discounted to today. I use financial statements, financial ratios, capital budgeting. I use cost of capital, the weighted average cost of capital. I'm also using time value of money, bringing all of it together, thinking of what is the value of these 10 years of cash flows in today's terms and trying to understand how to value that in today's terms. If I can do this, I can value any equity model, any equity, any stock, any debt, any cash flow that you give me. I'll be able to value this using DCF or using other transaction comparables or other methods like transaction comparables, peer comps. I can look at trading comps. What are they trading at? You need to kind of understand what these different valuation models are. So the golden resource that I can suggest for this is Ashwath Damodaran's course. He's considered a god of finance. And that's like, it's complete. I think it's still underrated calling him the god of finance because he's literally solving so many things at once. His course is the Bible of how investing works, and it takes a lot of time to understand it properly. But if you're someone who's really interested in learning more and understanding how finance actually works, how we model things, you need to watch his course. You need to understand how things are. And if you are watching it as a beginner, keep that in mind that this is meant to be advanced. It is meant to not be the easiest thing ever. It might dissuade you from taking finance as well, but it's important that you get your feet dirty and get into it from now itself. But Ashwath Damodaran is your best bet for this. If not that, there are multiple others. I'll again be linking them in the description, but like the literal honeypot in this is Ashwath Damodaran's online course. He's a teacher at NYU who puts his entire course that they teach in their MBAs, in their Masters in Financial Risk Engineering, everything, all of that together. He puts that online for free. In fact, one of my closest friends studied with him in NYU, and it's the exact same thing that he was taught over there that we can see on YouTube. So please make sure you use this resource, make sure you're doing it really well. And the last thing I want to talk about, the ninth or the 10th, wherever we are in the list, the ninth item that I want to talk about is financial modeling. This is very important. And why is it different from valuation methodology? Is because this actually requires putting it into paper. I want you to understand that thinking about a valuation model is different from actually linking up each and every cell onto Excel and making sure that for the next 10 years, it flows through accordingly and you get the output that you want. I can show you what a brief model looks like, but essentially we think about drivers, we think about the next steps, we think about what the future looks like, how the drivers are affected with time, with other forces. For example, if a company is more exposed to the flows of inflation and how the general consumer spending goes, and I'll account for it in a certain way. I'll think about the drivers, the forecast in a certain way. I'll use my cost of capital, etc. Make sure that the 10 years reflect that. I do this very methodologically in Excel, make sure that each and every statement is linking. Once I'm able to do that, I discount those to my today's value using the weighted average cost of capital, which is a separate slide in my Excel sheet. Make a separate sheet, figure out the WACC, which you already learned about in capital budgeting and cost of capital. Once you're done with that, you go down and you figure out what today's value is. Using today's value, figure out whether an investment model is worth investing in or not. And this is more based on Excel. The earlier method was more based on understanding valuation and how it works. So financial modeling is a culmination of everything that you've done so far. It's a culmination of all topics coming together into one financial model. The best source for this is practice. To be very honest, it's practicing the first 8 things that I've said again and again. Link this to Excel, learn Excel nicely. Lots of courses for Excel you can find it online, but for financial Excel, one of the best places I can let you know is Corporate Finance Institute again. They have an entire, I think, 2-hour webinar on how the 3 financial statements are linked and how to make a financial model from this. Linked in the description, watch the video, we'll put it on your screen, how they're making things. But that's kind of what matters, right? You link up everything in such a way that in the end, the answer gives you sufficient proof and data for what you need to know and how you need to go about making a model and why that is your current stance. They explain each and everything that you want to know. So if you know this, you'll be able to answer so many questions that the companies will ask you in your summer placements, in your final placements. And this will also help you understand if you want to take finance as a curriculum or if you want to do a marketing or something else in your MBA, right? So if you spend time watching this video and if you spend time reading a few of these articles, yourself will be making life a lot easier, be it choosing your field or choosing corporates or careers that you want to choose. So that was my goal for this video. If there are any questions, please leave them in the comments. I'll be more than happy to answer. If you enjoyed the content, please subscribe and stay tuned to the channel because there's a lot more of this coming out. But I'll see you in the next one. My name's Anay Dave. Bye.